Hey, it's Owen here with Owen Finance, your gateway to smarter investments, sharper financial insights, and also the ever evolving world of crypto and much more. Ready to level up your financial game? Let's dive in. Imagine walking into a fancy restaurant and trying to decipher a menu that's entirely in French, and you only know bonjour. That's how many new investors feel when they see a company's financial statements. There's a lot of mysterious terminology, big numbers, and all the charm of a textbook on advanced calculus. Today, let's break down those cryptic statements: income statement, balance sheet, and statement of cash flows, so you can read them like a pro without resorting to random guesswork or tarot cards. Many people assume reading financial statements is just for accountants, or that it's about as exciting as watching paint dry. But the truth is, these documents can tell you if a company is a hidden gem or a sinking ship about to blow your savings. First, let's define what these statements are. They're basically the official stories companies tell about their money, how much they make, where they spend it, and how it all stacks up at the end of the day. If a business is like a person, then the income statement is how much salary they earn, the balance sheet is their overall net worth, and the cash flow statement is how they actually handle their paycheck every month. When you pick up any company's statements, you'll usually find three major parts. The first is the income statement, also called the profit and amp, loss or P and amp, L. This is a snapshot of how the company performed over a specific period, showing all revenue, the money they earned, and expenses, the money they spent. The second part is the balance sheet, which is more like a freeze frame picture showing what the company owns, what it owes, and whatever remains for the owners at a point in time. Third is the statement of cash flows, revealing how cold hard cash moves in and out, regardless of any fancy accounting illusions. If the numbers on a balance sheet are telling you the company is big and strong, the cash flow statement will let you know whether they're actually paying their bills or living off credit like an overconfident influencer. Let's dive deeper into the income statement. You'll see revenue, also referred to as sales or turnover, at the top. Then come the costs directly associated with producing whatever the company sells: materials, manufacturing expenses, sometimes even labor, forming what's called the cost of goods sold. Subtract those costs from revenue, and you get gross profit. From there, you deduct overheads like marketing, R and amp winking and laughing, office rent, and yes, the occasional questionable executive bonus to arrive at operating income. Finally, you consider interest, taxes, and any side hustles or side fiascos, ending up with the ultimate figure: net income. This final number is the profit for that period, the one that can sound huge in headlines, but keep in mind, it's not always telling the full story. How do we interpret these numbers without falling asleep or falling into a trap? Look at trends. Are sales growing steadily? Is the gross margin healthy? If revenue grows but profits stay flat, it might mean costs are ballooning. Also, compare these figures year over year or quarter over quarter. A sudden spike in expenses might be explained by a big expansion, but it could also mean the CEO is redecorating the office with gold-plated desks. Now, let's pivot to the balance sheet. If the income statement is all about performance over time, the balance sheet is like checking your bank account at midnight on the 31st to see if you can still afford rent. A company's balance sheet is broken down into assets: what it owns, liabilities, what it owes, and equity, the difference between the two. Under assets, you'll find current assets, like cash and items that can be turned into cash quickly, e.g. accounts receivable, which is money owed by customers, and non-current assets, property, patents, expensive coffee machines, anything that sticks around for more than a year. Liabilities work similarly. Current liabilities are obligations due within a year, supplier invoices, short-term loans, while long-term liabilities might be those epic mortgages or bonds due in 5, 10, or sometimes 30 years. It's important to see how these line items stack up. Does the company have more short-term debts than cash on hand? That's a red flag. The official word for that is "oh no," especially if the firm can't roll over those debts easily. Equity, sometimes called shareholders' equity, is basically what would remain if the company sold all its assets and paid off all its debts, similar to the leftover pizza slices after everyone takes their share. For investors, it can act as a safety net or a measure of confidence that the company can handle a few storms without going bankrupt. Next, we come to the statement of cash flows. It's divided into three sections: operating activities, investing activities, and financing activities. Operating cash flow essentially shows the cash the business generates or burns through its main operations, like a bakery making money from selling bread, not from selling off old ovens. If the income statement is bragging about big net income, but the operating cash flow is consistently negative, that's like someone claiming to earn a huge salary, but always having an empty bank account by the end of the month. Don't be fooled by creative accounting. Cash is reality. The investing activities section details how much money goes into new assets. Think factories, equipment, or even acquisitions of other companies, and how much cash comes in from selling old stuff. This can signal growth if the firm is investing heavily in future capacity, but it can also be a sign of trouble if they keep buying questionable ventures. Financing activities reflect how a company raises money, issuing stocks or taking on loans, and how it returns money to shareholders, paying dividends or buying back stock. If a company's always issuing new shares to stay afloat, existing shareholders might see their stake diluted faster than a cheap cocktail. One of the coolest parts is seeing how these three statements link. Net income flows from the income statement into the equity section of the balance sheet as retained earnings, and also starts off the operating cash flow section, with some adjustments for non-cash items like depreciation. The end of period cash figure from the cash flow statement appears as the cash line on the balance sheet. If you find numbers that don't match up, you might have found an accounting error, or just the world's greatest example of corporate creativity. Beyond those basics, you'll want to consider some key ratios. For liquidity, you have the current ratio or quick ratio. These measure whether the company can pay its short-term obligations if that big storm of bills arrives tomorrow. On the profitability side, keep an eye on return on equity, ROE, return on assets, ROA, and the dreaded debt-to-equity ratio. An ROE of 20% can indicate a money-making machine. A high debt-to-equity might suggest the company borrowed more than your friend who claims to be totally fine financially, yet always forgets their wallet at dinner. Speaking of red flags, watch out for too good to be true statements. Did revenue suddenly triple with no clear explanation? Are liabilities hidden in off-balance sheet structures? Some companies push the boundaries, legally or otherwise, to make statements look more appealing. They might delay expenses to future periods or count projected income early. One trick is using acquisitions to inflate revenue or shift costs around. If you see big swings but can't find consistent reasons, it's time to do more detective work. Remember, if a CEO can't clearly explain the numbers, it might be because they'd prefer you didn't look too closely. A quick example: imagine a fictional gadget maker that reported $100 million in net income last year. Sounds great, right? But then, you look at their cash flow statement and see operating cash flow is consistently negative. It might be because the company's piling up receivables, lots of sales, but not actually collecting payment, or it's heavily discounting products to ship them off quickly, or maybe it's burying something else entirely. Either way, the net income alone doesn't tell the whole story. By checking the balance sheet, you might see a huge spike in inventory and accounts receivable. That's a sign the income statement's big profit is mostly on paper. Good luck paying real bills with imaginary money. Beginners often make a few common mistakes, focusing only on revenue. It's so big, or net income. It's positive, so everything must be fine. Another is ignoring the difference between short-term and long-term debt. If a company must roll over a bunch of debt next month and interest rates just shot up, that balloon might pop. And of course, too many novices take management's word at face value. A little skepticism goes a long way in finance, like reading a used car ad that says mint condition and then noticing the engine is missing. The last point is about resources for further study and final reminders. It's crucial to look at multiple periods, Get some historical data and see if the company is consistent, cyclical, or just plain chaotic. You can consult official filings like annual reports, often called 10K in the US or Virachnis Prava in certain European contexts. Analyst calls can also offer clues. If the CFO's dancing around questions like a politician, that's your hint to pay extra attention. And if you ever get bored, check out a different set of statements from a competitor to compare margins and growth rates. Nothing is more enlightening than seeing one company thrive while its rival quietly circles the drain. Now you have the basics to translate that arcane financial language into something you can use for smarter decisions. Understanding these statements won't just help you evaluate potential investments, it'll also sharpen your sense for when the numbers smell fishy. With a little practice, you can read a balance sheet for breakfast, an income statement for lunch, and a statement of cash flows for dessert, without choking on all the jargon. And if anyone tries to impress you with random finance buzzwords, you can politely inform them you're already on speaking terms with ROE and operating cash flow. The more you know, the more prepared you'll be to spot both great opportunities and well-disguised risks. And hopefully, you can do it without pulling out your hair or calling your accountant in a panic every other day. Because, trust me, accountants have enough stress dealing with these statements themselves.
Thank you for watching. If you liked the video, don't forget to give a like and subscribe to support us. If you are interested in our premium content, please also visit our Patreon. You can find the link in the description. Thank you, and take care of yourself and your finances.